Zack Apoian, looking around the world, you would prefer to put your money in U.S. and emerging market stocks. Why are these the best places for people's capital?
Well, that's right, Greg. I think with the U.S., you have the world's strongest economy. You have the companies with the most robust earnings, best opportunities for growth. You pay a small premium right now, but we think 17.5 times in the U.S. versus 15.5 times globally, it's worth it given kind of these extra opportunities.
And then over in Europe, you like Great Britain rather than the continent. This is a little bit surprising considering Brexit.
Right. Perhaps counterintuitive. I think in both areas you have uncertainty. In the UK, there is, questions about should companies invest or not. But the bottom line is these companies are largely global companies. They benefit from currency depreciation as well as kind of this industrial recovery we've seen over the last year. On the other hand, in continental Europe, there are a lot more questions. There are fears about kind of the other nations with strong balance sheets, perhaps leaving the continent, having similar Brexit type initiatives, as well as the fact that there has been growth in Europe, but it simply has not translated to profits we've expected.
All right, and you're an asset allocation specialist, so let's talk about bonds as well.
Okay.
You are advising your clients to avoid long duration bonds. Right now, the 10-year Treasury, which is almost in the middle, it's at 1.7% in terms of its yield. It's been stuck there for a while. So tell me, where you think it's going to end the year?
Yeah, it's very hard to say where we think it will end the year. It's probably somewhere around here. We don't have a strong view, but we would put kind of more upside to rates than downside. I think the fact is that there's simply very little term premium, right? There's very little compensation for tying up your money in these long-dated bonds right now. And based on that, we would advise avoiding them.
But if you need yield, you like high yield. High yield's had a great run this year after the energy woes last year. So should we put those energy problems behind high yield? Are they all done with?
I mean, we're comforted by the fact that the energy situation appears to have stabilized. We do see, this industrial recovery, which helps, as well as we see kind of aggregate demand in the world picking up in the third quarter. So that's all positive. And despite the fact that high yields had such a strong run, spreads of high yield bonds are basically near historical averages. So you are compensated for taking this risk, where on the interest rate side, it's not so much the case.
But finally, you want to avoid bond proxies, though. So if you're seeing nice yields in BDCs or REITs, you say be wary of those.
Yeah, absolutely. Really, if you look at the last several years, as yields have declined, kind of these safe assets have traded much more in line with long-term rates, and consequently they're looking expensive just as long-term bonds are looking expensive. So we see them all as part of one safety trade that is very expensive right now. It's prone to perhaps have more volatility than you'd expect going into the end of the year.
All right. Well, thanks a lot for coming by, Zack.
Thanks, Greg. Appreciate it.
And thank you for watching The Street.